Hi, and welcome to the X22 Report Spotlight. Today we have a returning guest, Rick Rule. Rick is the president and CEO of Sprott US Holdings, Inc. Rick has dedicated his entire adult life to many aspects of natural resource securities investing. Rick is a frequent speaker at industry conferences and is interviewed for numerous radio, television, print, and online media outlets concerning natural resource investment and industry topics. And I am very happy to have him back on the X22 Report Spotlight. Rick, welcome back to the Spotlight.
Always a pleasure. Thank you for the opportunity.
Hey, thanks for being here. And I wanted to get your take on what is happening out in Europe. There's a report out there saying that there's about 114 banks that are in trouble in Italy. We know there are banks that are having problems in Spain, in France, in Germany. And I wanted to get your take on what is happening out in Europe. I mean, are the banking system in Europe, are they solid, or are there real problems out there?
I suspect there are real problems out there, although I also suspect personally that those problems have been diminished over the last 3 years. The ultra low interest rates that we have seen on deposits in Europe, as well as the maintenance of interest paid on private sector loans, has meant that the European Economic Community has deliberately impoverished savers and depositors to improve the capital position of the bank. The difficulty is that there are still an awful lot of distortions with regards to the mechanism used to value the so-called assets, that is, the loans of these banks. And the difficulty that we have is really twofold. The first is that there isn't really a money market in Europe, a free market, money market in Europe, or the United States for that matter. There is a manipulated spread between the deposit rate and the lending rate. So we don't know how the banks would or will perform if the government were to lose control of the money market. And secondly, we don't know or have any confidence in the real state of the bank balance sheet. And these include the state-controlled banks. So although you asked me a very specific question, I don't have a very specific answer because the truth is being, I believe, deliberately obfuscated.
Now, what's very interesting is that the ECB, they came out and they said that, maybe we don't need the depositor insurance in the banks because they see the depositor insurance as promoting a bank run if something should happen. I mean, do you think having the depositor insurance would promote a bank run? I mean, we don't know why they're saying this. Why do you think they want to get rid of the depositor insurance on these banks?
Well, you will know that centrally sponsored deposit insurance really isn't deposit insurance if they change their mind retroactively. Deposit insurance provides you security if the bank run is limited to one or two institutions. What we've seen, certainly in the case of Cyprus, is that depositors really truly do become unsecured creditors in the event that there's a broader liquidity crisis. I don't want a headline saying that Rick Rule forecasts a broad liquidity crisis, but I do think that deposit insurance becomes, in a real crisis, a dangerous fiction, because it is controlled by a group whose interest is in maintaining the interest of all stakeholders, not just depositors, in the event of a liquidity crisis. People who rely on deposit insurance are people who rely on the goodwill of the state, and they need to understand that goodwill for what it is. Certainly, the suggestion by the European central banks that they don't need deposit insurance may be a reflection of the European central bank's belief that they have the circumstance well enough contained and that there is enough faith in European capital markets that they can get away without providing deposit insurance. My suspicion is that that's a very ill-founded belief.
Yeah, I wanted to move on to the U.S. and the economy here. And, since Trump came into office, we see, GDP, they're reporting that, it's over 3% now. They're telling us that the economy looks great. The stock market continually moves up. I think it hit 24,000 points. When you take a look at the economy, has everything just completely improved and everything's absolutely fine now?
I think that the message is actually mixed. I don't think it's as bad as many commentators believe, because many commentators are believing that the Western world as we know it ends tomorrow. I believe that most commentators in the market are confusing liquidity. There's lots of cash in the system with solvency. Specifically, as a society, our income statement looks pretty good. The private sector in the United States, in particular the S&P 500, are in robust financial health. The 2008 financial crisis had a sobering effect on corporate America, so that rather than hiding debt on the balance sheet, they're actually hiding cash offshore. The margins for S&P 500 companies are at historically high levels. Their capital allocation and capital efficiency is great. Export earnings are increasing despite a strong U.S. dollar. So the private sector in the United States, at least the most efficient parts of the private sector in the United States, are in good health. The problem then is not the private sector income statement, but rather society's balance sheet. We owe at the federal level in excess of $20 trillion in on-balance sheet liabilities and well in excess of $120 trillion in off-balance sheet liabilities before taking into account real and contingent liabilities at the state and local level and before taking into account chronically underfunded private pension funds. Now, the political class will tell you that this isn't a problem because we owe the debt to ourselves. That's not true. The spenders owe it to the savers. And given that spenders outnumber the savers, in a democracy, I think what you can count on are political circumstances where the spenders find a way to obviate their obligation to the savers. And I think this is where the real trouble is in the United States. The political outcome of the fact that our current liabilities are unsustainable, even irrespective of the liquidity and the confidence that's in the system today. This is a difficult concept for many people to understand. But if you bring it down to a person, there might be a person that has $10,000 cash in his or her jeans. And so in that sense, they don't have an immediate crisis, but they have $1 million mortgage, which their income does not allow them to pay. This person is liquid, but not solvent. And that's the dichotomy that I think that American citizens need to consider in terms of planning their own financial future.
So while, you're talking about the economy right now, and you're saying on a federal level, we have problems. But we also see the private retail industry where that right now there's a retail apocalypse where people aren't going out and spending their funds. Yes, I know people say that, it's the Amazon effect, but online sales only make up around 10% or so of all retail sales. How do we explain that people aren't going out and spending their money in retail, and all these stores are declaring bankruptcy, they're closing down, and we see a huge amount of, problems in this area?
That's a really good question. And I think that points to the fact that although the United States as a whole has improved in an economic sense, the improvement does not touch all parts of our society. People misunderstand the nature of wealth. Wealth is the surplus of utility generated relative to utility consumed. And unfortunately, many Americans, for various reasons, lack of education, lack of understanding, lack of savings, consume more utility than they generate. Given that our economy is increasingly driven by the consumer, and given that many parts of the United States society don't generate sufficient utility to have disposable income and savings, what you see is the gradual unwinding of the middle class economic engine. There are parts of the United States, like the part that I live in, San Diego County, California, where high skill, high value added people have generated what is truly a robust economy. That doesn't mean that there aren't people in San Diego who are hurting. The fact that they live around so many productive rich people means that, as an example, rent and housing costs here are very high. But if you compare this part of the economy with other parts of the economy, more traditional parts of the economy, where formerly middle-class wage earners are competing with more efficient economic producers, that is, lower wage producers in other parts of the world, the benefits of the U.S. economy, while they're being equitably distributed, that is, they're distributed to the people who generate the profits, aren't being evenly distributed. And I think that's what you're seeing in retail.
Let's move on to precious metals. We see in the last couple of weeks, there's a lot of paper gold contracts that have been thrown into the precious metals market where they suppress the price of gold. And, why is this happening? Who are these people doing it? Do you think there's a war on gold right now to keep the gold price down? Because it's just strange that all of a sudden, in the last couple of weeks, we've had, thousands upon thousands of these paper contracts thrown at gold, and it brings the gold price down, but gold then starts moving up again. What's your take on why this is happening?
I believe that all major asset classes are manipulated from time to time. And I believe that central bankers and central governments have an interest in not allowing the gold price to reflect fears about broader economic management. I also, however, believe that gold's weakness is more a function of faith in the U.S. dollar and the U.S. 10-year Treasury, and frankly, more a function of the boredom that the broad market feel with regards to gold than any form of manipulation. When I look back at the gold price over 40 years, it is undeniable that from time to time, trading desks or somebody deliberately sells large amounts of gold during periods of time when the market is illiquid. This isn't an activity that one would engage in if one was looking to maximize one's return from the trade. In other words, if you are looking to be taken advantage of on the sell side by selling into illiquidity, that's not a rational economic action. But I would also suggest that the gold community itself expresses its disappointment in the gold trade by making up boogeymen. And I think that this is a sort of a self-defeating inclination on the part of the gold community. I also believe it's unnecessary, and I think it stems from the fact that people in the gold community believe that they should be rewarded for owning gold in a time frame that's more immediate than reality would suggest. In my experience, the most important determinant of the gold price is the spread between the U.S. 10-year Treasury and the U.S. 10-year strip. In other words, it's really a function of faith in the U.S. dollar, and in particular, the U.S. dollar represented by the U.S. 10-year Treasury. And in that regard, I have what I think is very good news for gold bugs. U.S. 10-year Treasury has been in a 35-year bull market, with the interest rate peaking in 1981 or 1982 at 15.6. It's currently around 2.1. Now, that doesn't suggest we are necessarily at the end of the bull market for the U.S. 10-year Treasury. But after a 35-year bull market where the prices advanced to the extent that the yield has declined from 15.6 to 2.1, nobody can argue that we aren't closer to the end of that bull market than the beginning. And if you also agree that gold and the U.S. 10-year are reciprocal trades, that would suggest to me that gold is closer to the beginning of a bull market than to the end of a bull market. I know that's a very weighty and wordy answer, but my suspicion is that we have seen a period for the last 18 months where gold has done well despite the dollar doing well. In other words, that it has risen or at least held its value concurrently. And my suspicion is that this trade has another 18 months to play out, but will ultimately play out with a weakening in the U.S. dollar relative to gold. It's unlikely that that will take place in a time frame that suits investors who have trauma holding an asset class over a long weekend. But the truth is that gold has done a very good job for a very long time, maintaining its purchasing power irrespective of people's faith in alternative stores of value, in particular the U.S. 10-year Treasury.
So we see the BRIC nations, they made an announcement where they're looking to form a gold trade settlement, and they want it to begin in 2018, maybe, establish a new benchmark. How will this affect the gold market when if they go ahead with this?
Well, certainly alternative means of settlement and trading are good for any market. Adding competing mechanisms for traders is always useful because it lowers the cost and increases the probability of bespoke service. So any additional trading platforms or any commodity are good for markets and good for that community. The follow-on suggestion, I think, that BRIC governments would like to use gold to legitimize their own currencies or own securities is, I think, unlikely to happen. The idea that any political elite, whether they be a Washington elite, a European elite, a Russian elite, a Chinese elite, would tether their freedom, or rather their power, by linking it directly to gold is a non-starter. I think what the BRICS would like to do is divorce themselves as much as they can from the tyranny of the U.S. government and the U.S. government's ability to propose extraterritorial restriction on the sovereignty of BRIC countries. And I can't blame them for that.
I mean, at the same time, Russia and China, they've been accumulating a huge amount of gold. And from what you just said, they're not going to use this to back any type of currency. Then if they're not going to, why have they been accumulating so much gold over the last couple of years?
This is the $64 billion question. And I think that goes to the fact that gold has, for 3,000 years, not merely been a medium of exchange, but rather also a store of value. Gold is not a promise to pay. It's payment in and of itself. If relationships between the United States, as an example, and China and Russia, as an example, deteriorated, and the Russians and the Chinese were holders of U.S. government obligations, the U.S. government could simply say, too bad, so sad, we don't like you, we aren't going to pay. If the Russians and the Chinese, by contrast, held gold, the U.S. government could say what it wished, to who it wished. The asset that these countries have would not simultaneously be a U.S. liability. They would not be a promise to pay, but rather would be payment themselves. The Russian government and the Chinese government holding gold in preference to U.S. government securities says something about the opinion of those political leaders of the efficacy of gold relative to fiat currencies. An opinion I think that other private savers, non-sovereigns, should pay attention to.
So Russia came out with a very strange statement where Russia has threatened the U.S. not to confiscate their gold with sanctions. Now, they just came out with this statement, and it looks like, their offshore gold holdings, their offshore reserves, they're telling the U.S. this would be financial war. Why do you think all of a sudden they came out and mentioned gold and their reserves and, telling the U.S. hands off?
I don't really have an opinion about that. I think that a lot of the current rhetoric between the United States and Russia has as much to do with domestic politics in both parts of the world as it does in their relationship with each other. I think there's an interesting symmetry between the populist, nationalist, irrational rhetoric of Trump and Putin. In effect, I think they deserve each other. And I think a lot of the rhetoric that comes from both sides, while it may be international sparring, has as much to do with domestic political posturing as it has to do with anything else.
Let's move on to the petro-yuan and the petrodollar, because China introduced the petro-yuan. Venezuela was out there saying, listen, we're going to switch from the dollar over to the petro-yuan. Other countries are saying that we're going to be doing the same. Is this going to have a major effect on the dollar? And if so, will it also then trickle down to gold?
Certainly, the increase in China's role in the global economy over 20 or 30 years will have an impact on the dollar. The United States has enjoyed enormous benefit from being the world's reserve currency. One consequence of that, and a consequence of being the best and most liquid and most or least opaque debt market in the world, has been that U.S. borrowing costs have been illogically low relative to the balance sheet of the United States. And the increasing size of the Chinese economy and the apparent solvency, I say apparent because of the opaque nature of the Chinese reserve accounts, weaken the hegemony of the U.S. dollar and the U.S. Treasury market in global financial settlements. In other words, they weaken the U.S. monopoly, the monopoly that the U.S. currency has in global settlements. And that will certainly, over decades, weaken the seigniorage that's enjoyed by the United States at the expense of every other country in the world. Now, the truth is, this is a very gradual process. When we at Sprott have talked to sovereign wealth funds in other countries about the size and depth of their U.S. Treasury holdings, asking them, in effect, why they would loan the U.S. government money for 10 years at 2.1%, and whether or not they trusted the U.S. government, the response has been nearly uniform, that they don't really trust the U.S. government, but they trust the U.S. government more than they trust each other. And that the depth and the liquidity, and in particular, the visibility of U.S. accounts and the U.S. Treasury market make it, for the intermediate term, in other words, for the next 10 years, certainly a much more viable option for savings than the yuan. The Chinese will work away at this, and to the extent that the Chinese are able to continue to generate substantial economic surplus because of the utility that their labor creates for the world's consumers, they will become an increasingly important competitor to the United States on a global basis.
From what you're saying is that, people are still purchasing the treasuries because they still have faith in the U.S. compared to other countries. But as the Fed, the ECB, and the rest of the central banking systems as they continue on with stimulus, keeping the interest rates lower, sometimes in negative territory. How long can they keep this faith going?
You've taken a $64 billion question and made it a $64 trillion question. The truth is that the United States has an absolutely spectacular franchise to squander, and we're doing our absolute best to wreck our birth rate. The strength in the U.S. dollar that we've seen in the last 2 years, I think, is due more to the weakness of our competitors than any internal virtuousness in the United States. I have heard it said that the U.S. dollar is the worst currency in the world except all of the others. Doug Casey put it perhaps more eloquently when he said that the U.S. dollar is the prettiest mare at the slaughterhouse. When we look at our problems in the United States relative to where we started or where we could be, our performance is scandalous. It's traitorous. When we look at our performance relative to our competitors, including the Chinese, with regards to the opaqueness of their statement of accounts and their financial condition, the United States suddenly looks less bad. By the way, I'm not advocating that your listeners buy U.S. treasuries. I'm just trying to explain away the dichotomy between the balance sheet of our society and the relative strength of our debt obligations and security.
I wanted to wrap this up with Janet Yellen and Ben Bernanke, where Ben Bernanke, during 2008, during the same year, he said that everything was contained. And Janet Yellen came out and she used the C word. And this is what she said. She said, although asset valuations are high by historical standards, overall vulnerabilities in the financial sector appear moderate as the banking system is well capitalized and broad measures of leverage and credit growth remain contained. Does this worry you? Because first she said, we're not going to see another financial crisis in our lifetime. And now she's using the word contained, just like Ben Bernanke did months before, everything completely fell apart here in the U.S.
It worries me deeply. Mrs. Yellen, Mr. Bernanke, and Mr. Greenspan are very skilled political tacticians and frankly, very skilled economists. What makes me nervous is that none of them has ever really had a job. I'm not a political commentator, and I certainly couldn't compete with Mrs. Yellen in terms of what she does. But I have been a lender for 30 years. And my nervousness is that in my experience as a lender, the asset values that she refers to are ephemeral, while the debts that she ignores are at least allegedly money good. The solvency that she talks about in the private side of the U.S. banking, assuming that interest rates stay where they are and asset values stay where they are, means that the U.S. banking system is robust. The problem is if the Fed lost control of the money markets and the interest rates went up by 200 basis points, debts in some circles would become unfundable. And as a consequence of that, asset prices and then collateral values would fall. So the solvency that Mrs. Yellen refers to is really a function of ephemeral asset values based on current interest rates. You know, and I know, if the 30-year mortgage rate, as an example, were to go up by 200 basis points, the affordability on single-family residences across the United States would fall. Some people would be forced to sell as a consequence of foreclosure, while the asset itself, housing, would be less affordable. It doesn't take very much by way of an affordability crisis to bring down single-family residential prices across the United States. We saw that happen in 2008 and 2009. If that happens, the asset values of the loans in the banking system declines very, very radically. And the solvency which Mrs. Yellen refers to, and the confidence which we see reflected in asset prices in the United States, begins to go away. If you have a circumstance where the concern becomes solvency, not liquidity, then we have a problem. And we have a problem which Mrs. Yellen did not address.
Rick, thank you very much for being on the X22 Report Spotlight. Once again, how can people see your work?
I would be delighted if people subscribe to our blog. You can do that by emailing contacts@sprottglobal.com, or alternatively emailing me personally, rrule, that's RRULE, @sprottglobal.com.
Thank you very much for being on the Spotlight. And I'm going to be putting all the links at the bottom of this video to make it easier for people to find the information. And once again, thank you very much for being on the Spotlight.
Thank you very much. I enjoyed your intelligent questions.
No, thank you. I enjoyed your answers.